Hi, good afternoon, everyone. Welcome back to the channel. So we have a returning special guest again today, Howard Chen, CEO of Kurv Investments. Welcome back, Howard. So great to have you back on.
Great to be back, Coach.
So there's definitely been some updates since the last time we talked. The first topic we wanted to cover was about the trust
Yeah,
with Curve. Yeah. So do you want to go
yes.
ahead and tell the audience all about that?
Sure. If you are a shareholder or owner of one of Curve's ETFs, on Friday, I think you would have received a proxy vote. And the vote is for uh, the first six single name cover call ETFs we issued out of a series trust. And during the 2014, we actually set up our own trust in which we already launched one of our newest ETF, KQQQ, in that trust. And so the vote is to move the six existing ETFs into our own trust. So all of the ETFs are under one umbrella, the Curve ETF umbrella. And we're doing this for operational efficiency. So again, once everything is in the ETF trust, Curve is actually going to be the sole advisor for all 7 ETFs. Currently, I think we've mentioned in a previous case, the 6 existing ETF is sub-advised by NEOS, who's obviously very expert in executing in options. But now that we have all 6 plus the KQQQ under the ETF trust, we can actually consolidate all of the trading together. And we think that will bring operational efficiency. And also we expect it to have a lower cost in trading and managing the portfolios.
Okay. And are there other advantages like to the investor when it comes to that?
Yeah. So first of all, I should mention that the funds are exactly the same. All of the custodians remains the same. The fees all the same. We Because we have KQQQ, we have sufficient volume in trading and options, and then now combined with the existing 6, that gives us a pretty good critical mass in terms of both trading in options, but also technical things like posting collateral. It's all done the same way, making sure that all the margins is set up properly for all 7 funds together in one place. So those are really efficiency gains. And then we do have a couple of things that we're putting in place now that I can't talk about, but hopefully I'll come back next time. But there's actually
Mhm.
additional sort of benefits that we're planning going into the end of the year plus in beginning of 2025. Yeah.
Okay. And are there any new funds in the works?
We do have two. We have 2 new funds that sort of been approved, but we've been waiting. There's too many things going, so we've been waiting to transition these into the trust before we launch new funds. Yeah.
Okay. Okay. Great. Um, any like SEC like prospectuses out there that we could reference or anything?
There are 2 that's already been approved. So I think I mentioned that last time I was here. So you can obviously take a look, and we're pretty excited about those ETFs as well. And part of those actually will leverage sort of kind of infrastructure we're building uh, to partially to consolidate all of the tradings. Yeah.
Okay. Oh, infrastructure to consolidate all of the tradings. What does your trading team look like now?
So the portfolio. Oh, I should mention actually. So the
Hmm.
new portfolio manager is by the name of Dominique Terson.
Okay.
He's actually somebody I used to work with at PIMCO when
Ah, I
we
figured.
were
Yeah. Hmm.
building the European ETF business. And not only was he dedicated on ETF capital liquidity in all of our ETFs, but he actually was the person who managed most of the short-term portfolios at PIMCO, liquidity portfolios at
Oh,
PIMCO.
wow.
So he is very expert in terms of how trading mechanic works, how to spot liquidities, and also one of the things that maybe is not very apparent is when you're trading fixed income, you're trading cents, right? Like the yield is like, oh my gosh, it went from 5 to 3.25%, right? So like the returns you get are so in many ways, when you trade fixed income, you have to be especially careful with expenses and costs, so you don't lose out and on the alpha that you have, right?
Mm-hmm.
So he brings that same sort of attention on making sure the expenses and the cost, the trading cost, to try to minimize that as much as possible in all of our ETFs. And that's something, I always joke about, the market is going to do what it does, so that affects returns. But the one thing that managers can always control is the expenses and costs that you incur in the fund. So that is a priority for us, to minimize that as much as possible.
Great. Yeah, I agree. That's awesome. So for the 6, you are excluding KQQQ from the 6, right?
Yes, the KQQQ
Okay.
is already in our own trust. So we're moving the other 6 into that same trust where KQQQ is already sits.
Oh, right. Okay. So all 7 will actually be there.
Correct. Yeah.
Okay. So for KQQQ, we were talking a little bit offline about this. You were talking about benefits to the average retail investor's portfolio for this one.
Yeah, it's kind of interesting. I do sometimes look at the comments on some videos that people cover, and I think there's sort of this kind of mystery on where to actually bucket this particular fund. And to be very honest, I think it is a unique product, so it's a little bit difficult to put them where it is. But this fund is, I think, when I previously came on here, it came out of the fact that we appreciated that people wanted income, but we never, if we wanted a long-term exposure in the fund, a straight cover call strategy might not be as effective, because obviously you do limit some upside potential, right, to generate that income.
Mm-hmm.
And so how do you get price return when tech is surging and appreciating in price, and then also get a sufficient amount of income in a strategy, but not capping off the upside? So this is really trying to capture a bit of best of both worlds, in particular the tech space. So this strategy holds about 15 to 20 of the largest tech name. And the way that we think about how this fits in is that we compare ourselves with a passively managed triple Q,
Mm-hmm.
right? So that is just tracking NASDAQ 100, whether it's tech exposure or not, or non-tech exposure. And we want to outperform that. And in fact, since we launched it, we've almost outperformed it by 1%. So it's 2.5 months of history. So it's short, but we've managed to outperform our boogie here. The other thing is, triple Q distribution rate is 0.65, something around there.
Mm-hmm.
All right. And we've been able to, through dynamic cover call writing, be able to generate, at least in the last, this is 7% in this fund, right? So that's like a almost 6.5% advantage, right? So it's not going to generate like a 10 to 12 as a straight cover call ETF, right? Because we don't have 100% of the notional covered all the time. All right. We really want to say, if the market is going up, we get price return. And then when the market is going down or it's moving sideways, we write cover calls to generate income.
Mm-hmm.
So that's really sort of the dynamic nature of the strategy. And actually, in fact, we launched it at the end of July, which has kind of gone through a small mini cycle where the market's corrected and then rebounded. If
Yep.
you compare our performance relative to just a straight QQQ or other cover call ETF strategies, we've actually outperformed most of our competitors in this particular strategy. So in this fund, and I want to be really like, we care about total return. We want to generate income, but we also want to capture the price. So this is something a little bit unique. So I can understand why people can't really fit it in a bucket, because it's I don't think actually the bucket exists, right? So if you go for triple Q, you get mostly price return, no income. If you go strictly to a cover call strategy that writes cover calls on the NASDAQ 100, you get good income, but your upside is kind of limited. So we're really trying to get best of both worlds here. So the key here is to look at total return.
Right, total return. And I just number checked your dividend here. So yeah, it is 7%. You're going off what it was last month. It was 14 cents, it looks like, and annualizing that. Yep.
So that was like a few weeks after we launched, so we haven't gotten full. We have to take time to generate the income in the portfolio. Yeah.
Right. So you've been public since what, July 23rd?
22nd, yeah.
22nd. Okay.
Yeah.
Okay. And then if we look at total return, now I would say your competitors in this one are going to be like a FEPI and probably like a YMAG.
You can compare us with that, and I think we've done pretty well relative to some of those funds too. So I think
you have.
So that's my point. Is sort of where we want to generate income, but we also want to get price return, right?
Exactly.
And we talk to a lot of investors a lot about that, and especially I look at some of the chat rooms, and I know a lot of people are really focused on income, and I get it if that's really supplementing your income, which our 6 existing cover call ETFs will do that. But when you have a rental property, if you get a good rental payment and the value of your house drops 50%, that's not great, right? So you have to think about both components of your investment. So
that's a great analogy. Yep. Because a lot of people compare these to real estate.
Yeah, I've seen it. I've seen in the comments. And to be honest, I was looking at how people are using a lot of these option income strategies. I mean, it's very interesting. There's the drip, thing that people talk about, which actually in essence is essentially total return. You're reinvesting your income into the fund, right? So you're essentially your income is going back into the fund, and you're looking at total return. So that's a very key component on that. I think some people are maybe using leverage to get the monthly payment. That's also something I think pretty common that I'm reading into it. So I think just we will keep saying it, which is like the quality of your distribution is very important, and
yes.
I think we try to get our investors as best quality of distribution as possible. Yeah.
Yep. So I'm looking here. I did the dates, and I went ahead and put in FEPI and YMAG. Why not? And yeah, it is outperforming in price return since inception. And what other index would you say, like for Mag 7 would be a good like benchmark, like for an income fund?
For income fund, I mean purely cover calls. I know there's some buy right index, but internally we actually have it's self-calculated, so we can't publish it. I think we're going to try to publish it and just disclose that we but we actually look at the top 15 components of the NASDAQ. Because that's actually the more realistic benchmark for our strategy, because we're trying to invest in the largest tech names. And part of it is actually, if you want to generate fairly consistent income, you need to make sure that these companies is an ongoing concern, right? Like they are not going to go bankrupt tomorrow, right? There's this stability in the business. So that's why part of the thesis is that we've seen outperformance from some of the largest companies, and we see that divergence continue to widen out. So we think this is a good strategic exposure to have in the portfolio.
Yeah. So in total return, yeah, KQQQ is 1.61%. The other two comparables are less. Very interesting. And then to review your holdings here again, so it's mostly the tech. You've got basically the Mag 7 Amazon, Apple, Alphabet, Meta, Nvidia, Broadcom, Microsoft, Tesla.
Yeah.
Yep.
And so if you take a look, actually, part of the efficiency of this fund is if the model is telling us that we should write a cover call and we have an ETF in that particular name, we will buy our own ETFs because that reduces sort of the it consolidates basically the exposure, and it gets better performance. So, our set of products are working together to hopefully generate a good amount of performance for the investors.
Right. And since we're speaking of comparisons, so we were talking offline about you guys get a lot of comparison questions,
We
and
do.
yeah, and you're also close to your 1-year anniversary. So between October 26th and 31st, all these funds launched.
Yeah, we launched October 26th and October 30th, 31st, depending on if you count the day before listing of 2023. So we're at the end of this month, we're reaching our 1-year anniversary.
So it was a Halloween launch date for half of them.
It was. We were hoping
Yeah.
it wasn't like scaring anybody, but yes.
Trick or treat.
Yeah,
Yeah.
exactly. Yeah.
Yep. So, and you actually have performance comparisons on your site, correct?
We do. We often, obviously, get questions about competitors. So I think when I first came on, when we first launched the ETF, we were sort of talking about how we manage the ETF in an institutional way. We write our calls a little bit out of the money for your audience, like 30 delta calls. And so we want to, again, similar to KQQQ, we want to generate pretty consistent, decent distribution, but also capture some of the upswing and the price returns for these names, right? Because they're growth stocks, so they're going to, when there's momentum, there's going to be price appreciation in these names. So we want to capture some of that.
Mm-hmm.
So obviously, the question we constantly get asked is, well, how are you different than certain competitors that you have? How do you perform? And so as we get to the 1st-year anniversary, I think a lot of our thesis is now reality. We can actually, instead of talking in theory, how the realized performance is doing, right? So we know there's a lot of concerns about NAV erosion. We've never gone through a reverse split. Our distribution is very consistent. Or rather, we think it's and ultimately the thing that we get measured on is how much total return we generate for the clients, right? So we just compared with peers in the space, and since inception, we have been able to generate quite attractive returns, total returns.
I see. Yeah. Yep.
And I want to be very clear, right? So for the beginning of the year to July, the Tesla stock has been sort of falling, and so we're generally pretty much in line with competition because you fully harvest the premium on the call that you're writing, right? If it keeps falling, it's never going to be in the money. You get the premiums that you're getting, right? But what something changed in July for Tesla is that you had this sudden increase in price appreciation in the Tesla stock, right? And this is where the way we manage really shines, is because we write our call a little bit out of the money. We're able to capture a lot of that price appreciation. On top of that, still writing the cover call, right? So if you're writing your call at the money or very close to spot, you're going to be capped out immediately. And so a lot of the outperformance is because we have been able to capture those sudden surges of price appreciation. And this is a behavior of the Tesla stock, right? You have these sudden news that all of a sudden it jumps. You can't really predict them. So you have to manage it in a way that when it happens, you're able to capture some of that upside.
Right.
So that's proven out. Our thesis have proven out, to work.
Yeah, definitely. So I wonder why other um, I why do you think other funds don't do the same? Do you think it's like a risk tolerance thing?
No, I mean, our advertised yield is lower, right?
Hmm.
We have less premium. That's
Right.
for sure, right? So I always talk about this. Some people who you know understand what I'm saying like really gets it, and then others I think I always try to find new examples. It's like
Hmm.
we can have 100% distribution yield. If
Right.
you give me $100 and I give it back to you $100, that's
Yep.
100% yield. But
Exactly.
is
You're
that
just yeah.
what you want though, right? And actually, to be honest, it's not. I won't give you back $100 because you give me $100. There's a management fee, right?
Hmm.
So that's 99. And then when I distribute back to you, if it's not the kind of earnings, if it's ordinary income, it's actually 37% less of that, if whatever, depending on your tax record. It's
Right.
taxed, right? So you're not getting 100%, $100 back, even
Hmm.
though the distribution yield's 100%
Right.
or 99%. So and this is something that we try to do as much education as possible, is that the headline yield is not the only determination on the quality of the investment and the distribution that you get.
Hmm. And I think most of this audience agrees with that because we like we're fine with lower yield with stable NAV or even increasing NAV.
Yeah, so our NAV is slowly increasing, but like we do actually ultimately have to distribute that out, but um, because of a RIC, a register, you have to distribute about 90% of the investment gains in the portfolio. But what we don't want to do is eat into the NAV, right? Have NAV erosion and distribute more than basically giving you money back that we should have been using to generate an additional dollar. So
Hmm.
yeah.
Here's a good comment here. I own 5 of your ETFs: Goop, AMZP, NFLP, AAPY, and MSFY. A good way to buy quality companies and generate a reasonable income. Pretty good return of capital, so the distributions are fairly tax efficient. Yep.
So one thing to notice, that's a really good point. Thanks for bringing that up. Because the Tesla stock have been falling, before the year end, and we our fiscal year end is in May. We What we filed to the IRS, you can actually go on our website for Tesla and Apple. 99% of the distribution is return of capital. So they're not immediately taxed until you sell the ETF. Yeah.
Yep. Here's a good question. So talking about KQQQ, what percentage of a portfolio do you think would be a good idea to possibly allocate to KQQQ?
So the way that we think, we believe, and obviously have to give the caveat, everybody's investment portfolio is a little bit different, but we see KQQQ as a substitute for large cap growth.
Hmm.
So whatever you have in your portfolio, if you look at the S&P 500, 60% is like of the largest company, right? So and then the 40% is the smaller subset. Um, Whatever your allocation to SPY, we think it could be a substitute for that 60%, or it could be a complement. Because or if you have triple Q, it's actually a interesting substitute, because triple Q doesn't distribute, like I said, distribute 0.62%, right? And so you have similar exposure to triple Q, and the current distribution rate is 7%. So that's something that is, I will say the distribution rate for KQQQ is dynamic. So when the market is going up, we write less cover calls. When the market is going down, we write more. So it can range between 4 to 12%. When the market is going down, we could write 100% of the portfolio. So that would be equal to just a straight cover call ETF on the Nasdaq 100, which is around 10 to 12% yield. So we have this range because income for that portfolio, we look at total return. You have income. It might be a little bit dynamic, but you also get price return. So
Very true. And price return is very important. Let's see. Serious question. If I have several years experience doing only covered calls, but always did well, could I potentially just do my own options as I initially started and outperform any others?
Yeah, I mean, I think this just comes to the amount of time and focus that you want to have. What we do with a single name cover call ETF is try to make it easy for people who don't have the time, right? If you have the time, you know, it makes sense to do it in your own portfolio. The one caveat is generally, and it depends on the size of your portfolio. So if you have a sizable portfolio and you're trading options on a retail brokerage account, the pricing sometimes is actually about 10 times more than the institutional pricing. That's how sort of brokerages work, and finance works is like the larger your AUM, the economy of scales you have, the pricing will go down, and that's also part of the reason why we're consolidating all 7 ETFs into one trust, right? We can get that economy of scales to um, to to get good pricing. The But if you can do that yourself, you focus on which names that you want, you understand the Greeks, how far you out, how much risk you want to take, go do it in your portfolio. That's perfect. I mean, many people do it. The one other thing I would mention that's a benefit in using an ETF is if you have multiple cover call positions and you want to exit it, you have to unwind all the trades. So you have to buy the cover call back, right? Which
Right.
also in an ETF, you just sell the shares of the ETF, and you unwind and you exit the strategy. So that's another benefit that people sometimes use. It's like, I know how to do it, but I just want to be in and out, or I want to get the income, and then sometimes if the market turns, I want to be out of it. That's an advantage in using ETFs.
Hmm.
The last thing I would mention is that the way that we structured our ETFs, we use a synthetic long. We can do some tax loss harvesting, which requires more attention. You can certainly do that in your own portfolios, but that's just more components to think about in your own brokerage account.
Yeah, good points. I see this question a lot, actually. People that just say, "Oh, I can do this myself." Okay. Any high yield funds? Well, actually, what's your highest yield fund? Is it TSLP?
It's TSLP. It
Yeah.
usually ranges between 25 to 30%, and we've been pretty consistent in that yield. I call it distribution volatility. So actually, if you go to strategies,
Yeah.
and then you go to income strategy drop down,
Hmm.
if you scroll down, we actually plot basically our distribution dollars. We've been pretty consistently stable, and that's one of the things we actually focus on, because we know many people are using this as a supplement to their income. So you want some predictability,
Hmm.
and in particular. For Amazon Group, we did an announcement basically because the stocks underlying has done pretty well. We're actually going into the year end, we have had increased distribution because we have to distribute those out. So
Hmm.
you could look, actually distributions have been sort of going up actually.
I see
Um,
that. Yeah, the trend line would definitely be up in the last 6 months here and
yeah.
here. I think for all of them.
I will say and this is just a market thing, in the last couple of months or quarter, vol has actually been fairly low.
Hmm.
Just as a market pricing of uncertainty has been pretty low. So um, uh, we have this bank that we use to try to make sure distribution is as consistent as possible. Yeah, I would say so. To answer the question, high yield funds. So the highest yield is Tesla, and then actually, I believe Netflix and Amazon's are also fairly high up there.
Hmm. Yeah, I think on your main page you used to have the percentages there.
Oh yeah, if you could go to strategies and then just yield premium,
Oh yeah,
and then that's a we get questions on it. So that's a summary of all of the distribution.
there it is. Yep.
Yeah.
Hmm. So yeah, about 26% is your maximum. So to answer his question, it's not like high yield, like yield max. Like you're not going to see 50 to 70%, but you're seeing price appreciation and a stable yield, which I think is a good thing. Let's see. So he's asking, are there any protections or fail-safe setup in your options trades compared to what I would do myself?
Yes. So we have a daily portfolio management, risk management monitor to make sure that our exposure is always in line. There's a couple of things that we do to reduce risk. So the synthetic long that we have in the portfolio, we roll only quarterly. So that's something that we reduce the frequency, partially because we want to reduce trading costs, but also the less you do it is, reduces the amount of mistakes, right? The cover calls we do roll on a monthly basis, but those generally are pretty routine. So that's pretty straightforward. I will say KQQQ is the one that has the most amount of turnover in trading because the market changes quite a bit. And so you will see, for example, last month, 65% of the portfolio was covered with cover calls on the individual names. And then this month is much lower because momentum has gone up. So we want to get more of the price return. So in those sense, we actually have a daily monitor to see where the deltas of every single call options that we have, and then how it moves to make sure we're in line with exposure. So we have a lot of risk monitors that Dom use to make sure we're in line.
Great. Let's see. So we did go over this already as far as comparable funds. We mentioned FEPI and YMAG. He says, can this I think this is a Vanguard fund, VGT.
I'm not sure. I don't know the fund, but I could take a look at it. Yeah, if it sounds like a growth tech fund, maybe Vanguard growth tech fund, if I'm guessing the ticker.
Yeah.
But I mean, we do have it is exposure to growth technology names. So it would be similar exposure, but I don't know for instance, what the distribution is, right? If it's like the index, it would be sub 1%. But I shouldn't say, I don't really know the fund. So
this is a growth fund, actually. Yeah, Vanguard growth technology. Information technology. Sorry, Vanguard information technology. Yeah, 21% for the year.
Yeah. So the way, maybe just to briefly describe sort of the difference is KQQQ doesn't just invest in sort of software company. The way that we define technology is sort of any business that has used technology to disrupt its vertical, right? So we do have exposure, for example, Apple, NVIDIA, Microsoft, Broadcom, etc. But we also have exposures to like Netflix, which has used technology to deliver media.
Yep.
And the last thing that's a little bit different is that oftentimes when people use NASDAQ as a proxy, they assume all of NASDAQ is sort of technology focused. But all that means is basically is all of the names that are listed on the NASDAQ exchange. So in our portfolio, you'll actually see other names that are not on NASDAQ. For instance, we own Oracle, which have done very well this year. That's listed on the New York Stock Exchange. And so we're kind of agnostic on where things are listed, but rather, oh, well, there you go.
Yeah. Since inception, you're beating VGT in total return. Yeah.
Yeah. So we try to, obviously I want to give the disclosure, right? So we have a size bias. So we have we have the largest company. So when size doesn't do well, we will most likely underperform, right?
Yeah.
But we're trying to offset some of that underperformance through income generation with the cover calls.
I will caveat, I've noticed with most of these funds that I've seen, and I've been studying these for about a year and a half, in the short term, they can beat a growth fund, but typically the growth fund does have that more long-term, really, really attractive return in terms of like price return. But yeah, in the short term, I have seen these outperform.
Yeah.
Let's see, a couple more questions here. If I annualize 2 distributions to date for KQQQ, the distribution comes to 5.5. Does this sound correct? Further, I'm not seeing a 19-to-1 statement on return of capital on your site. To the first part, I can actually answer that because so he's averaging your first dividend, your second dividend. The 7% that we mentioned is if you're taking that second dividend and annualizing it. So yeah, 5.5% is probably, if you take both of them, that's probably what it is.
Yeah. So with that fund, because we are more tactical in terms of when we are writing cover calls, when we first launched it, it was sort of, I think, only a few weeks to the first distribution date. So we weren't like we were invested, but the cover call program is just getting started to generate income. And so the second distribution is a little bit more reflective because we had a whole entire month to generate the distribution.
Yep. This one, let's see. We'll see if you can answer this. Would it make sense to keep all your funds in a brokerage, not IRA, but a regular brokerage account, assuming Curve promises tax efficiency?
Yeah. We know a lot of people actually hold these in IRAs, and so in some ways that some of the tax efficiency is less because you're either in a tax deferred account or a tax exempt account, right? Whether it's Roth or IRA. You do take advantage more of the tax efficiency when it's in a taxable account because now some of the distributions are not immediately taxed or is tax deferred, so that your tax occurs obviously in a taxable account, so that would be where you can realize more of the efficiency than in an IRA. And I think the way that I've seen people use it is essentially they're supplementing income. So a lot of it sits in a taxable account, but you want to make sure that it doesn't become ordinary. The highest tax bracket, right, is ordinary income, right? There's different buckets. There's ordinary income, long-term capital gains, and return of capital. So if you hold this for more than a year, the gains are taxed at long-term capital. But if you don't sell and you reinvest, you're essentially the portion that's return of capital, you're reinvesting tax deferred. So you're essentially doing what you're doing in an IRA in a taxable account. But
okay.
you have to talk to your tax advisor. But that's essentially what you're doing, right? Because you're reinvesting without a portion of the tax being taken away. You're just fully reinvesting it. Yeah.
Okay. Yeah, so he says, this is great. You're explaining things in a way most don't go into detail about. Send a special thanks to everyone that works on these funds. Very impressed. The definitions on the stance clearly defined. Great. Okay, so yeah, for this one, was there anything else that you wanted to go over for the audience?
No, I thank you for all the people who've been supporting Curve. We're reaching our 1-year anniversary. We're very excited about that.
Yep.
I hope we have shown now, not just in theory, like how we manage portfolios, and we hope to obviously continue that.
Yeah, for sure. It seems like you guys are doing great, and congrats on the 1-year anniversary coming up.
Yeah, thank you.
Yep. So we'll go ahead and end it there on this one. We are going to be on the podcast next. We sent that link out to the audience. Thank you all so much for tuning in and for all the great questions. Like, comment, and subscribe, and join Discord and check out Curve Funds. And we'll see you all in the next one. Take care. Bye.
Thank you.
All right. So I sent you that link, and we'll see you over there.